Alright, dear students, welcome to the financial reporting exam. And in this lecture, we are going to discuss the IAS 12 adjustment, which is the taxation adjustment in the final account question. And when we say final account question, that means the single entity financial statement question, and also for the objective test questions or objective test case questions. So first of all, we need to understand that what goes to the statement of the profit or loss. So usually in the exam, we have the current year tax provision, which is the current year tax estimate, and we are going to look at the questions in a while. And then you will see mostly we have the current year tax estimate or the current year tax provision scenarios in the question. But you may have the reference scenario if there is a current year tax provision that is your current liability within the statement of financial position, and when it is the reference scenario that is the current asset within the statement of the financial position. So this figure, usually the current year tax provision goes to the current liability in the statement of financial position, because when it comes to the final account question, you need to understand that what goes and where. And then we have the under provision. Now, under provision is coming from the previous year, and under provision represents the debit balance in the trial balance. And remember, this increases the tax charge. So current year tax provision, we take that in the positive figure, and if it is a refund, we take that in the negative, because we are doing the expense working. So expense represents the positive figure, and if there's income or the reversal of expense, that represents the negative figure. The over provision represents the credit balance in the trial balance, and this decreases the current year tax charge. So if there is under provision, that increases the current year tax charge, and if there is over provision, that decreases the current year tax charge. And then we take the increase in the deferred tax liability. So how we usually calculate it, if there is no, for example, deferred tax on revaluation, then we simply compare the opening deferred tax liability with the closing, and if it is increasing, that increase is the expense, and decrease in the deferred tax liability is the reduction in the expense. And the opposite goes for the deferred tax asset, and usually we have the deferred tax liability question in the exam, but you may have the deferred tax asset scenario as well. So increase in the deferred tax asset represents the decrease in the expense, and the decrease in the deferred tax asset represents the expense itself. So then you get the statement of the profit or loss figure that goes to the statement of the profit or loss in the tax expense. Like we have the profit before tax, and then we have the tax, then we have the profit for the year. So this figure goes to the statement of the profit or loss tax expense figure. Now, this increase and decrease is a simple scenario when we do not have any revaluation in the question. Like sometimes the examiner says ignore the deferred tax on revaluation, and sometimes they consider the deferred tax on revaluation. We'll be doing all types of question you may see in an exam. So deferred tax working, remember the closing balance. We are talking about the deferred tax liability right now, because this is mostly tested in the exam. We are talking about the deferred tax liability. So the closing balance of the deferred tax liability is recorded as a non-current liability, in the statement of financial position. Now, when it comes to the exam, this is something very important to understand, that when it comes to the exam, examiner may give you the closing balance of the deferred tax liability directly in an exam question. So the first scenario is the given. That means when you go to the notes or additional information, the examiner gives you the closing deferred tax liability. Now within this, you need to see whether this says this includes the deferred tax on revaluation, or this does not include the deferred tax on revaluation. So these will be two scenarios. Deferred tax being included and deferred tax is not included. Let me just show you how the examiner says in an exam question. So this is the first question, price well, and you see there is a current tax, and in the current tax it says note number 4. In the deferred tax again it says note number 4, and the current tax is on the debit side. So this current tax represents the under provision. And then the deferred tax, so it is not written deferred tax asset or deferred tax liability, so it is quite for granted that because it's on the credit side of the trial balance, this is the deferred tax liability. Okay, so now let's go to the information which is in the note number 4, and let's see what the examiner has to say regarding this. It says the directors have estimated the provision for income tax for the year end 31st March 20x9, which is the year end, at 4.5 million. So this is the current year tax estimate, which is the current year tax provision. This is the figure that we take over here in the current year tax provision. I'm going to solve it in a while. The required deferred tax provision is 5.6 million. So the required deferred tax provision, that means they have already given you the deferred tax liability at year end. This is the closing deferred tax. And you see there is no information regarding the deferred tax on revaluation because in this question we do not have that. And it says the balance of the current tax in the trial balance represents the under or over provision. Examiner does not tell you whether it's under or over, and you need to see it yourself because it's on the debit side. So this current tax represents the under provision. Examiner says it's under or over provision. So we need to see ourselves that if it is on the debit side, this is the under provision, and if it is on the credit side, this is the over provision. So this is quite simple. So this adjustment we can now solve it, and how we can do it, just simply, okay, let me just remove these figures first, which I have written over here, so that you can clearly see the figures I'm writing over here. Again, this as well. Okay, so it says the current year tax provision, which is given in an exam question, and how much it is 4.5 million. So in the exam, if we are doing the working in 000, remember we will be writing 4500 because the trial balance is in the 000 as well. So all the workings are in 000. So 4.5 million means that again you are going to do in the 000, so 4500. And then we are having the under provision, which increases the tax charge of 700. So closing deferred tax is how much? Closing deferred tax is given in the notes, which is 5600. So let's put this as well, 5600 less the opening balance, which is given in the trial balance, is 8400. So that means 2800 is the decrease in the deferred tax liability, and decreases the current year expense. So current year tax estimate is the expense, that is why we took the positive figure. Under provision increases the tax charge, that is why we are adding it in the current year expense, and decrease in the liability is the reduction in expense, that is why we are deducting it. So which figure goes to the statement of profit or loss? 2400 goes to the statement of profit or loss, 4500 goes to the current liability, and 5600 goes to the non-current liability. So this is how we are going to do this first question, in which we have no revaluation things. So let's just remove the figure so we can move to the next question. Okay, so as I said, that you need to see that when the closing balance of the deferred tax is given, whether this includes the deferred tax on revaluation or excludes the deferred tax on revaluation. And then if the closing deferred tax is not given, then they give you the temporary differences. They give you the temporary differences. And how we can do it is simply taxable temporary difference. And we know when the carrying value is more than the tax base, then there is a taxable temporary difference, multiply by the tax rate. So you get the deferred tax liabilities. So usually it's given in the exam, but sometimes examiner give you the temporary difference, taxable temporary difference, and then you just multiply it with the tax rate to calculate the deferred tax liability. So this was the uh, question price well which we did from your Kaplan kit. And now we are moving to the next question, and the next question is Highwood. So Highwood is, you may have a different number in your kit, so you just see the name of the question rather than the number. So we see the current tax is given and it's on the credit side. So we know when the current tax is on the credit side, this represents over provision. And then we have the deferred tax again on the credit side. So this represents the opening deferred tax liability, and it says that the rest is of the information is in the note number 3. Now we need to go to the note number 3. So note number 3 is the current tax represents the under over provision. Now we know this is an over provision because it's on the credit side. The required provision for income tax is 19.4 million. So again, it's the current liability being given, the current year tax estimate. The difference between the carrying amounts of the asset of Highwood, including the property revaluation above, and their tax base is 27 million. Now again, so the difference between the carrying amount of the asset and their tax base is 27 million. We don't have the direct deferred tax liability in the exam. It says that you have the temporary differences, and now you have calculated the deferred tax liability, and it says the temporary difference includes what? Again, this includes the property revaluation. So this 27 million includes the property revaluation. So first of all, we need to see the property in the trial balance. The property is at cost 75,000, and then we have the accumulated appreciation of 10,000. So 75,000 minus 10,000. 75,000 is the cost, and the accumulated appreciation is 10,000. So 65,000 is basically the carrying amount at the start of the year. And the start of the year is 1st April 20x0. It says the 1st April 20x0, Highwood decided to revalue its property. That means at the start of the year. The market value on this date is 80 million. So the fair value is 80 million, that means 80,000. Now the gain on the revaluation is 15,000. This is the gain on the revaluation. At this date, remaining life is 20 years. Highwood does not make a transfer to retained earning, and this is what we have regarding the revaluation of the property. Now we can do the tax working. So again, going back to the question, note number 3, it says the current year tax provision is 19.4 million. That means 19,400. And then we have the over provision, and over provision is 800, which decreases the current year tax charge. So we have this 800, and then we need to go to this deferred tax liability scenario. Okay, how we can do it? So we have the temporary difference being given in this question. Temporary difference being given in this question. Okay, so the temporary difference is how much? Going back to the trial balance? No, the additional information. So it says the temporary difference is 27 million. So what we can do is 27,000 into the tax rate. Now, how much is the tax rate? The tax rate is 25%. So we multiply it by 0.25. So we get this closing balance of the deferred tax liability. And then we need to deduct the opening balance. Again, going back to the trial balance and see the opening balance is 2600. So 2600. We get the increase in deferred tax liability, and we are yet to deduct the deferred tax on revaluation. So the gain on the revaluation was 15,000, which we have calculated over here, this 15,000, and then we multiply it by the tax rate, which is 0.25. So 15,000 is the gain. 15,000 is the gain, and the deferred tax on that gain is 25%. So it's 3750. So the net increase in the deferred tax liability is 400 that we are going to take over here. So the statement of profit or loss figure of the tax is 19,000. So this 19,000 is what we are going to record in the statement of the profit or loss. So again, just revising what we have said, that the gain on the revaluation is 15,000, and the deferred tax on revaluation is simply the gain multiplied by the tax rate. The closing deferred tax liability was not given. Instead, they gave us the temporary differences. So we multiplied the temporary differences with the tax rate. And this temporary difference includes the deferred tax on revaluation. The current year tax provision was 19,400, which represents your current liability. Over provision decreases the current year tax charge, and the net increase in the deferred tax liability was 400. So the profit or loss figure is 19,000. Okay, now let's remove it so that we can move to the next question. Okay, let's move to the next question. The next question from your Kaplan kit again is Keystone. Okay, this Keystone. So let's see within the trial balance where we have this deferred tax. So there's only deferred tax, and we don't have any current tax in this question. And it is on the credit side, so it represents the deferred tax liability. And this is the opening deferred tax liability of 2,700, and they have the note number 4 for us. So note number 4 says the provision for the income tax for the year ended 30 September is 24.3 million. Does that mean this is the current year tax estimate? We can straight away take it over here, 24,300. We don't have any underrow provision in this question. At 30th September, the tax base was 15 million less than their carrying amounts, or simply the carrying amount is more than the tax base. So if the carrying value is more than the tax base, or the tax base is less than the carrying amount, this represents the taxable temporary difference. And it says this excludes the effects of the revaluation of the lease property. That means in order to calculate the closing deferred tax, we need to add the the gain thing within this temporary difference. This 15,000 excludes the revaluation of the lease property. This is what the examiner has clearly stated over here. So first of all, let's go to the property within the trial balance, lease property. And where is that? Yes, property. The cost of the property is 50,000. The accumulated depreciation is 10,000. So the carrying amount is 40,000. Okay. So the cost is 50,000. Accumulated depreciation is 10,000, and the carrying amount is 40,000. This is the carrying value. Now let's see the fair value. The director decided to revalue the property in line with the recent increases in the values. On 1st October 20x0, that means at the start of the year, The independent survey, let's just confirm it whether it is the start of the year by just looking at the date. Yes, the year end is 30 September 20x1, so the start of the year is 1st October 20x0. The independent surveyor valued the property at 48 million. So the fair value is 48,000. That means the gain is 8,000. This is the gain. And it's, you see, the revaluation gain will create a deferred tax liability. Examiner has clearly stated. In some question they say ignore the deferred tax liability and revaluation, but in this question it clearly says that you need to take the revaluation into account. Okay, so it's fine. 15,000 is the taxable temporary difference, and this excludes the effect of the revaluation. So that means we are going to add the gain in it, which is 8,000, and then we multiply it by 30% to calculate the closing deferred tax liability. So this is the difference, includes, excludes. When it includes, then there is no need. You just multiply the taxable temporary difference with the tax rate. So the closing balance is 15,000 is the taxable temporary difference. Add the 8,000 in it, which is the gain on the revaluation, and then you multiply it by the tax rate. So tax rate is 0.3, 30%. Let's just confirm it. Yes, the tax rate in this question is 30%. So yes, 6,900 is the closing balance of the deferred tax liability. Okay, then we have the opening balance within the trial balance, and it is how much? It is 2,700. Okay, then we have the deferred tax on revaluation. So it is simply 8,000 is the gain amount multiplied by 0.3. So it's 2,400. That means net increase in the current deferred tax liability is 1,800. So we just take it over here. So that means the statement of the profit or loss figure of the tax is 26,100. And when you go to the current liability, you have the 24,300. This is the current tax payable. And this 6,900 is your non-current liability. Now, if I show you the extracts of the other comprehensive income or the revaluation surplus, so 8,000 is the gain on the revaluation, and then we deduct the deferred tax on revaluation. That means 8,000 into 0.3. So this is 2,400. So 8,000 and this. So you can use the sum formula in the exam. Simply is 5,600. So 5,600 is the amount that will go in the revaluation surplus and the other comprehensive income. So this is how you deal with the deferred tax within the final account question or the single entity company question, and the objective test question and the objective test case questions.